Yo traders, welcome back to Trader DNA, the channel where we take complex trading strategies and turn them into crystal clear step-by-step guides that even your grandma could follow. Today, I've got something insane for you. We're diving deep into a trading pattern that looks simple but can explode with power when used right. It's called the inside bar, and trust me, if you know how to spot it and trade it the right way, it could be your ticket to cleaner entries, tighter stop losses, and way better risk-reward setups. In this video, I'm going to show you what an inside bar really is. And no, it's not just small candle inside a big one. Why most traders use it the wrong way and lose money. How you can use it to catch explosive breakouts in trending markets. And exactly what to avoid so you don't get trapped by fake signals. Whether you're brand new to trading or already placing your own trades, by the end of this video you'll walk away with a high probability breakout strategy you can test today on your charts. So buckle up, open your trading platform, and let's break down the inside bar strategy, step by step. Alright, let's break this down because this part is where most new traders mess up big time. Take a look at this chart example. At first glance it looks like an inside bar, right? The body of the second candle is sitting nicely inside the range of the previous candle. But here's the catch. The high and the low of that second candle actually poke outside the first candle's range, and that means, boom, it's not a valid inside bar. So here's the million-dollar question. Why do inside bars even happen? Like, what's the point? Well, the inside bar isn't some magical signal that screams buy now or sell now. Nope, it's actually what we call a consolidation flag. That's just a fancy way of saying the market is basically taking a nap. During the time that second candle was forming, the market wasn't really moving anywhere important. It was just bouncing around inside the range of the previous candle. No breakout, no trend, just sideways noise. But don't ignore it because this pause in the market is a huge clue. Think of it like this. The bulls, buyers and the bears are in a standoff. Nobody's winning yet, they're both holding the line, but when that inside bar finally breaks out, boom, it usually means one side just overpowered the other and the market is about to explode in that direction. So, as a price action trader, when you see an inside bar forming, don't just sit there. This is your cue, your signal that a battle is happening. And if you turn it right, you can jump in right before the next big move and ride that breakout like a wave. Bottom line, the inside bar isn't just a candle, it's a window of opportunity, and smart traders know how to use it to their advantage. Okay, now you're probably wondering, how do I actually trade the inside bar? Great question, because this is where most people either start winning or totally blow it, so listen closely. Step 1, when you open your chart, do not just start clicking buy or sell like a maniac. You need to stop and ask yourself 4 critical questions that will save you from disaster. 1, is the market trending up? 2, is it trending down? 3, is it moving sideways in a range? 4, or is it just a total mess, completely unreadable? Before you even think about trading an inside bar, you've got to understand the market structure. Think of it like the weather forecast for trading. You don't wear sunglasses in a thunderstorm, right? Same goes here. Let me give you a crystal clear example. Look at this chart. See how the market keeps making higher highs and higher lows? That's a textbook uptrend. And that tells us something super important. The buyers are in control. They've got the power, they're pushing price higher, and your best move, ride the wave and look for buy opportunities. So now, inside that uptrend, we spot a beautiful little inside bar pattern. Boom, this is our moment. Remember what we said earlier? An inside bar is like a pause button on the market. It's the calm before the storm. So what do? We don't panic, we don't guess. We simply wait for the breakout of that inside bar and then jump in with a buy entry that follows the main trend. What we're doing here is smart. We're not trading randomly, we're aligning with the trend and using the inside bar breakout as our entry signal. That gives us a better chance of catching big moves with a solid entry price. Pro tip, you're going to see a ton of inside bars on your charts, like everywhere. But don't get click happy and try to trade every single one. That's a rookie mistake. Some inside bars form during super quiet, boring markets where there's just no momentum. And if you try to trade those, you're basically flipping a coin. Not smart. Instead, focus on inside bars that form during active trends with real momentum behind them. That's where the money is. Alright, let me walk you through a real example, because this is where the strategy really starts to click. Take a look at this first chart. You'll notice the market is trending up, which is great. But hold on, look a little closer. Even though the overall direction is upward, the price action in this specific spot is barely moving. It's flat, it's slow, it's like watching paint dry. This is what we call a low momentum zone, and guess what? Trying to trade an inside bar during one of these quiet, slow motion moments is like trying to surf on a puddle. There's just no energy in the market to push your trade anywhere, and that makes it super risky. You could enter a trade, get stuck in the mud, and boom, your money's just sitting there doing nothing. Or worse, you get stopped out. So here's the deal. If you want to actually make money using inside bars, you've got to find them in the right kind of market. And by right, I mean a market that's actually trending, and not just trending. It needs to have some force behind it. A bit of speed, a bit of pressure, a bit of oomph. Now look at this second example. This is what we want. The trend is clearly heading up, and not only that, the movement is strong and consistent. The market's pushing higher, and boom, right in the middle of that momentum, you get a clean, perfect inside bar. Yes, this inside bar isn't random. It's not noise. It's a pause in the action, a breather before the market continues its climb, and that pause gives you the perfect opportunity to get in. Once the price breaks out of that inside bar, you jump in with a buy, riding the trend at the exact moment momentum kicks back in. That's how you catch the wave instead of missing it. So let's recap this golden rule. During an uptrend, don't just trade any inside bar. Look for inside bar setups that form in line with the trend, especially when the market shows strength. Avoid the weak choppy zones where price is just drifting sideways. Those setups will trap you. Trade smart, not random, and use the inside bar the way it was meant to be used, to catch powerful breakouts inside strong trends. Alright, so now you're probably asking, but wait, what if the market is going down instead of up? Can I still use the inside bar strategy? Heck yes, you can. Let me show you exactly how it works in a downtrend. So here's the deal. When we zoom out and analyze the market structure, we're not just guessing. We're looking at patterns that tell us who's in charge, the buyers or the sellers. And in this example right here, it's clear as day. The market is making lower highs and lower lows, which is the classic signature of a downtrend. That means the sellers are in control and they're pushing prices lower step by step. And guess what? That's great news for us as traders, but because now we know what to do. In a downtrend, our job is not to fight the trend or hope it magically reverses. Nope. Our goal is to join the sellers, ride back momentum, and look for smart, low-risk entries. Enter the inside bar setup. Yet this pattern works beautifully in both directions, not just during uptrends. In this case, the inside bar shows up right in the middle of a strong down move. That's your signal. It means the market just took a short pause, like it's catching its breath before continuing the fall. So what do? We don't panic. We don't rush. We wait for the breakout of the inside bar. And as soon as that candle breaks out to the downside, that's our green light to enter a sell trade. And remember, we're not just entering blindly. We're doing it with the trend at a moment when the market is already showing us it wants to go lower. Let me make this super simple. Uptrend, look for inside bar breakouts to buy. Downtrend, look for inside bar breakouts to sell. It's literally like following a map. The market gives you the direction and the inside bar tells you when to jump in. So now you've got the full picture. You know how to identify the trend, how to wait patiently for the setup, and how to place your entry with precision using one of the most powerful candlestick patterns out there. Alright, now that you know, how the heck do you actually recognize an inside bar when you see one on the chart? And whether you're dealing with an uptrend or a downtrend, let's talk about the most important part. How do you actually enter the trade? Where do you put your stop loss? And how do you take profit without getting repped? Let's break it down step by step. Step 1, the entry. When do you actually jump in? You don't just enter randomly. We're looking for a breakout. That means when the price breaks out of the inside bar's range, that's our signal. Why? Because this concerns the market has picked a direction and is ready to move. No guessing, no hoping. You're waiting for the market to tell you, let's go. Step 2, the stop loss. Protect your capital at all costs. This part is crucial. You must have a stop loss. You wouldn't drive a race car without brakes, right? Same here. So where do you place it? For a buy entry, put your stop just below the low of the inside bar. For a sell entry, put your stop just above the high of the inside bar. This keeps your risk tight and controlled. If the trade goes against you, you're out fast. Small loss, no big deal. That's how pros survive who thrive. Step 3, take profit. How to lock in games like a boss. Now for the fun part. How do you make money? You've got a few options here. Option 1, set a fixed reward to risk ratio. For example, if you're risking $10, go for a $20 profit. That's a 2-1 reward to risk ratio and it's a solid plan. Option 2, use price action or support resistance zones. Aim for a logical area where the price might stall. Option 3, trail your stop loss. Once the trade moves in your favor, move your stop to break even, then trail it behind each new swing high or low. This lets you ride the trend while locking in profits as it goes. Bonus tip, never move your stop loss further away just because you hope the trade will work out. That's not a strategy. That's gambling and this ain't Vegas. So to recap like a boss, entry equals wait for the breakout of the inside bar in the direction of the trend. Stop loss equals just outside the opposite end of the inside bar. Target equals either fixed RR, key levels, or a trading stop, whatever fits your trading plan. This is how you turn one simple candlestick pattern into a high probability, low risk trade setup that even beginners can use. Okay, but let's say the market is not trending. It's not going up, it's not going down, it's just kind of moving sideways like a confused chicken. So what do you do when the market is just bouncing between T-zones and you have no clear trend? Let me break this down for you step by step, because this is super important. Take a look at this chart. When we analyze the market structure here, we can clearly see that price is stuck between horizontal support and resistance levels. This is called a ranging market, or what some traders call a sideways market. And here's the key thing. In this situation, neither buyers nor sellers are in control. They're basically fighting each other to a draw. So the smartest move, don't chase trades in the middle of the range. That's where traders get chopped up. Instead, you want to make decisions at the edges, support and resistance. Now here's the cool part. Inside bar setups can work beautifully in this environment if you know where to look. Check this out. In this first example, we've got a crystal clear inside bar forming right at the resistance level. That's huge because this could be the market getting ready to reverse down. So what's the plan? Simple. Wait for the breakout below the inside bar, set your stop loss just above the inside bar, and target the next support level. That's your potential profit zone. Let's look at another one. This time the market is again ranging, but the inside bar forms at the support level. This is awesome because it means the market might be ready to bounce up. So what do? Wait for the breakout above the inside bar. Place a stop loss just below it. Target the next resistance level. It's like playing ping pong with the market. You're taking trades at the extreme point, not in the middle where everything is messy. Pro tip, in a range-bound market, your best trading opportunities are always going to be at support or resistance. That's where price reacts. That's where the action happens. You do not want to trade inside the range. It's boring, risky, and totally unpredictable. So remember, inside bar breakouts can work even when the market isn't trending, as long as you play them at the right locations. All right, check this out. Here's another chart example. But wait, what's going on here? This market looks like total chaos. It's a mess. There's no clear direction, no consistent pattern, and if you're staring at this like, what the heck am I even looking at? Congratulations, you're seeing it correctly. This kind of market is what we call unreadable or choppy. It's just bouncing around randomly with no trend, no rhythm, and honestly, no logic. And if you're thinking about trading in conditions like this, especially using inside bars, I've got just one word for you. Don't. Listen, if you spot an inside bar forming in this type of market, the best thing you can do is literally just ignore it. Why? Because in this kind of market, nobody knows what's going to happen next. Not me, not the pros, not your favorite YouTuber, no one. You might as well flip a coin. So rule number 1, only trade inside bars in clean, readable markets, period. Now here's where things get juicy. You've learned how to trade inside bars in uptrends, downtrends, and even during ranging markets. But there's one more skill you've absolutely got to learn if you want to survive and thrive as a trader: how to separate good inside bars from bad ones. Because trust me, inside bars are everywhere on the chart. Like, they pop up all the time. But here's the truth. Most of them are garbage. You can't treat every inside bar like a golden ticket. Otherwise, your account's going to go down faster than a roller coaster. So here's the game plan. You want to be looking for inside bars on the daily time frame or the 4-hour time frame. These are your sweet spots. You can go down to the 1-hour chart if you really want to, but anything lower than that? Nope. That's dangerous territory. If you try to trade inside bars on the 5-minute chart, guess what? You're not trading. You're gambling. And the only thing you'll walk away with is an empty account and a broken spirit. So if you want real results and real consistency, stick to higher time frames, wait for the clean setups, and filter out the noise. Okay, stop what you're doing and look at this chart. Seriously, just look at it. This is the 5-minute time frame, and at first glance, it looks like there's a bunch of inside bars showing up everywhere. And you might be thinking, well, that must be a goldmine of trading opportunities. But hold on, every single one of these setups failed, boom, 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 one loss after another. And that's totally normal. Why? Because here's the truth nobody tells you. Candlestick patterns like inside bars do not work reliably on lower time frames. And I'm talking about anything below the 1-hour chart. A 5-minute chart? That's basically market noise. It's like trying to read a novel by looking at one random letter at a time. Total chaos. You see, in these tiny time frames, the market moves way too fast and there's too much randomness. There's no real structure, no clear direction, and no time for the market to tell a proper story. Price action setups like inside bars need space to breathe, and they make a lot more sense when you're looking at bigger, slower time frames where real trends are forming. Now, if you're someone who loves speed and adrenaline and you've mastered scalping strategies, then sure, go ahead and explore those tiny time frames. But that's a whole different ballgame. That's not price action trading. That's like trying to win a drag race using strategy chess moves. It just doesn't fit. But if you're here because you want to learn how to trade smart, using clean setups, powerful signals and strong logic, then listen up. Stick to the higher time frames. I'm talking about the 4-hour chart, the daily chart. Those are your best friends. That's where price action patterns actually work, where trends are real, and where inside bars can become powerful signals instead of false alarms. Alright, now check this out. We're switching gears and jumping to the daily time frame, and whoa, do you see the difference? I mean, seriously, just look at how clean the chart is. It's like comparing a muddy puddle to crystal clear water. The noise is gone, a chaos disappears, and boom, the signals finally make sense. So the takeaway is simple. Don't fall for the illusion of low time frames. They're flashy, but dangerous. Focus on quality over quantity. Choose the charts that give you clarity, not confusion. Right here, we've got a textbook inside bar setup that absolutely crushed it. The breakout was clean, the direction was strong, and the result? Low risk, high reward. The kind of trade that traders dream about. But hold on, this might be the moment everything finally clicks for you. Now that you've seen the full breakdown of the inside bar pattern, what it is, how it works, when it shows up, and why it matters, I need you to develop a new habit starting right now. Every time you open your chart, whether it's H4 or daily time frame, make it a routine to scan for inside bars. Why? Because that tiny little 2-candle setup might just be the golden signal that a massive breakout is about to happen. And if you follow the rules we covered earlier, that signal could turn into a big juicy profit, the kind that makes trading exciting. Think of the inside bar like an alarm bell ringing on your chart. It's telling you, hey, something big might be coming, get ready. And if you've been watching closely, you now know exactly what to look for, how to confirm it, and when to jump in. That's how you get an edge in this game. And because I want to make this as easy and stress-free as possible for you, I've done something awesome. I've created a custom inside bar indicator. Yes, an actual tool that spots these patterns across any chart for you instantly. No more zooming in, squinkling at candles, or second guessing your eyes. Just upload the included template straight into your trading platform and boom, the whole system is ready to go. Zero setup, zero confusion, all power. Just click the download link in the description, add the template to your chart, and you're instantly trading with precision like a pro. And just to make sure you remember everything, here's your ultimate inside bar checklist. Step 1, always trade on higher time frames. I'm talking the hourly, the 4-hour, or the daily chart. Anything lower is like trying to fly blindfolded. Step 2, analyze the market structure. Is the market trending up, trending down, or just bouncing sideways in a range? You need to know this before making any moves. Step 3, use that inside bar breakout as your green light to enter the trade. Whether it's breaking out of the trend or bouncing off support or resistance, this is your moment to strike. And hey, if you've made it this far, you're now officially smarter than most people watching charts with no clue what they're doing. If this video helped even a tiny bit, smash that like button, hit subscribe like you're entering a trade with full conviction, and turn on notifications so you never miss a future strategy that could level up your trading game. Thanks for watching, stay sharp, and I'll see you in the next one. Let's go!